How's everybody doing? I get the most exciting topic, which is taxes. It's funny, this year was weird because we just finished our last, well, not our last deadline, but the 1040 deadline, and you cannot imagine how many people were calling me the day of and asking me if they can do the taxes. I was like, you're gonna have to do them late. But, let me see here. That's not mine. Okay. Okay, we got it there. So, like I mentioned, this is a business clinic, so I'm going to go through some personal. So I'm going to be talking about tax updates on the personal side. It is a business clinic, so I am, if time permits, I'm going to open the floor to have some questions. A lot of folks always ask me, so Abdiel, why you do what you do? And that's why I included the first picture. I do it because my partner in crime, and I have a family, I have 5 kiddos, Jasmine the oldest, and Timothy the youngest. And the reason I'm able to do that is because I have a team that backs me up. You know, Rosie and I and the team, we get the accolades, but really we can't do anything with the support team we have together. And how we do it, we have vehicles. We have our businesses, our non-for-profits that really allowed us to host these type of conferences totally free to the community. I like opening with a couple of quotes. The first one is, by failing to prepare, you're preparing to fail. A goal without a plan is just a wish. And my favorite, a prudent person foresees the danger ahead and takes precaution. The simpleton goes blindly on and suffers the consequences. I've been doing this for over 20 years, and you'd be surprised, again, people come to me to do their taxes, and then they're mesmerized why they owe a lot of money. And a lot of things happen. The reason why that happens is because they don't sit down and plan. There's a difference between tax preparation and tax planning, right? When you go to do your taxes, you just go, somebody goes prepare your taxes, and at the end of the day, what happens or the result, whether you get a return or refund, that's what they do. So I encourage everybody to start visiting with their tax preparer, CPA, whoever does your taxes, to start focusing on that. So today we're going to be talking about, again, personal taxes. I want to remind everybody, so this year we only have about 2 months. The tax deadline will be Monday, April 15th, 2024. And then if you go ahead, and usually folks that tend to owe money, they tend to extend it. Right? I don't know why, because it doesn't stop you from owing the money. I guess it's more of a psychological component. So that's very important. The deadline is next year is April 15th, 2024. The extension, which is a 6-month extension, is October. But also be sure to, those people who usually owe should be paying quarterly estimates, meaning that you should be paying quarterly payments. A couple of changes on the personal tax return. The standard deduction for 2023 for single taxpayers is $13,830. The married, if you're married, your standard deduction is $27,700. Head of household, $20,800. Tax credit, I like that because I have 5 kids, so that helps a lot, right? Earned income credit, we don't qualify anymore. I used to help. The big one, and this is some tax strategy you can use, but there's a law that in January 2022, it's called the Inflation Reduction Act. It addresses energy efficient, healthcare, and corporate. But for the sake of this conversation, there's a big initiative to try to get solar panels. How many people drive down the street and they see a bunch of stuff in the roof, right? The cool thing about this year is that you're able to get a tax credit of 30%, which is pretty substantial. So those folks, in fact, I just had a meeting with a client yesterday, and part of the tax strategy or the tax planning we were talking about, hey, I'm going to invest, I think it was $60,000 because it's going to help them reduce the electricity or whatnot. How can I implement that in my tax strategy? We had the discussion, and he's going to do the investment and potentially get a credit of $24,000 for putting solar panels. A big thing that has been wrapping up really quickly has been identity theft. In fact, I was speaking to a young lady yesterday, and when I filed a return, we get a response back from the IRS, and apparently this individual was a victim of identity theft. And she was mentioned to me yesterday that while she was driving, my office called and said, hey, you're a victim of the identity theft, and she freaked out. So I just wanted this opportunity to talk a little bit. If that happens, there's some steps that you and I need to take. First, contact the IRS to confirm that you did file a tax return, right? Next, you should be completing Form 14039, which is the identity theft affidavit. File a return. Also, file a complaint with the Federal Trade Commission at that website, identitytheft.gov. Then the other one, definitely contact one of the 3 major credit bureaus to make sure they flag your credit report, because if somebody took out your identity, that means they're using credit cards or doing something that potentially could definitely harm your future purchases or whatnot. And then, call your bank. Make sure you're calling your bank. Make sure you're calling your credit cards. Make sure you're doing all those good things. And then the next thing is make sure that any correspondence, for example, if you start getting correspondence from the IRS saying that you're getting a refund or you owe, and you say, wait, I haven't filed for anything, that means potentially you were a victim of identity theft. The next one I want to talk about would be audits. Audits have gone up rapidly. Like I mentioned earlier, I've been involved. I've been doing this for over 20 years, and this year alone, we've been involved in 5 audits from different agencies. It's because, as you know, the IRS passed a law. The Senate passed a law saying they're giving funding to the IRS, so now they're hiring more people. So now they're having the bandwidth to go and audit a lot of individuals. And like I said earlier, I'm going to open this time to have any questions as it relates to taxes or anything like that. Let me. We have some mics here, Ms. Kat. If anybody has questions, I'm going to start with one here, right? It says, what's the difference between a tax credit and a tax deduction? Right? I get a lot of these questions. A deduction reduces your taxable income, right? Usually a standard deduction. That's why I mentioned earlier that the standard deduction for 2023 is about $13,850, and then the other one, the itemized deduction, right? So when you go to do your taxes, it's very important because, as you may know or may not know, that we like automation because then we have the ability to charge a little bit higher for a tax return. But as a consumer, right, as somebody who's going out there to do their taxes, it's important to know what's the difference between that. So again, the deductions, deductions allow you to reduce your taxable income, and the credit gives you, credits directly reduce your tax liability. So that's a big difference as far as that goes. Anybody has a question?
Can you give an example of what tax planning might do for you, or like something you've seen in the past that your tax planning would help reduce or mitigate some taxes?
That's perfect. So usually around, we also do bookkeeping and tax preparation, bookkeeping and financial planning. What tax planning does is, like I mentioned earlier, tax planning is looking at your current financial situation in light of what's happening with the tax laws, and what things do you put in place so when you do your taxes in February, March, or April, you're at a position that you're not giving more money to the IRS, right? My job is not to make you pay more taxes. My job is to reduce the tax liability. Prime example of that is, like I said last week, or yesterday, I had a conversation with somebody who came in and said, Mr. Ruiz, my business is doing good. I'm netting, my net income is $120,000. In my mind, oh, snap, this person is going to be in the 28%. They're going to pay a lot of taxes. So what strategies do I put in place so when he does their taxes, they're not having to give away money to the IRS? And as I mentioned earlier, one of the tax strategies is using the 30%, right, solar panel, because they want to put that definitely in their house. Another strategy is potentially increasing their wages because they have a company that has a lot of money. So part of that is me giving them good news and say, hey, why don't you give yourself a $40,000 raise? What do you mean? Well, you have the money. Instead of giving it to the IRS, let's put those things to be able to reduce your net income. So when we do your taxes, you're not having to pay or give that money away to the IRS.
And just as a follow-up, when should you start that process?
Well, that process should start usually in September. It's a good month to start having the tax planning, because if you do your own books or who does your books, that should give them enough financial information to see where you are at and where, potentially what's going to happen in the third and fourth quarter of that year. So I highly recommend third quarter starting the conversation, but not to exceed, not to pass October, November. Because if you wait till December, there's not much, even though you could put strategies in place, you can't do anything because it's too late. Mm-hmm. I know this lady had a question. Okay. Anybody else? Aranda?
You mentioned auditing increasing. So how do you see that impacting nonprofits? And how often do you recommend that nonprofits do their own internal audits to be prepared?
So I'm thinking, just to clarify, there's two types of audits, right? You usually for non-for-profits, they hire a CPA firm. Hey, can you just run an audit to make sure that everything's running good? You get what is called an auditor financials. Usually you hire somebody to go audit to make sure you have policies in place, standard procedures, and all that is happening. I'm talking more about when the IRS knocks on your door or sends a letter saying, hey, by the way, you've been selected to have an audit. And like I tell a lot of clients, sometimes it's recommended for you to hire a professional, because this is a true story. I had a client about 2 months ago, did something wrong with one of the agencies, reported, called the agency, and literally this gentleman put himself into a full audit because he started getting nervous, started saying stuff he shouldn't. And the challenge with that is, and what happened was, and the auditor told me, he was so nervous and he just said a bunch of crazy stuff, and I didn't feel comfortable, and therefore he opened a full-fledged audit, and this was at the state level. So I highly encourage you just to seek counsel, right? Because if you're not aware of the laws, you're not aware of your rights, you don't want to put yourself in a position that you're getting audited. But just to clarify, there's two different types of audits. On the audits in which you engage a CPA or somebody with a license just to look at the books and making sure everything's right. Usually governmental agencies and all that, they do that because they get grants, and usually some of that is even noted within their guidelines or on their legal documents. Any other questions? In the back, Janetta.
Yeah, Stuart next to me had this question, but he was a little too nervous to ask, so I'll ask on his behalf. For quarterly tax breakouts, you mentioned that's a surprise if you're a new business owner. I've seen a mixed bag of it matching true quarter by quarter, but LLCs has a different quarterly breakout. Do you see that too, where it's not every 3 months, like you would think a conventional year broken down into quarters?
So usually it all depends how, so you bring a good point. So you have to go back and see if your legal structure is structured in such a way that it's a fiscal year or calendar year, right? So if you report to the IRS on a calendar year, which is January to December, and then fiscal, some churches, some non-for-profits may be from May to June, then that determines more or less how you pay quarterly taxes. Quarterly taxes for individuals is different than for corporations because depending legal structure matters. If you have a S corp, you don't pay quarterly taxes because your taxes pass through the corporation, right? So as it relates to legal structure, your legal structure determines if quarterly taxes are applicable. So for the sake of this conversation, when I talk about quarterly taxes, I'm talking about individuals, 1040s. And some folks, they may have businesses like a DBA or single member LLC. Those tend to require to do estimated payments or quarterly payments, which is usually in April, June, September, and now January. Those are usually, and how does estimate payments work? Basically, let's say, for example, last year you owed $4,000, then now it's your responsibility for the next 4 quarters to send to the IRS $1,000. Why? Because if you don't do that and you don't pay enough estimate payments to the IRS, what happens is that when you file your return, they're gonna penalize you and assess a penalty in your tax return because you didn't properly pay your estimated taxes because you knew you owed. So estimated taxes tend to be a reflection of what happened the previous tax year. Yes, ma'am, in the back.
Is there a deadline for the ERC credit? Have they established a deadline?
And I'm gonna definitely talk about that in the business component. So I don't know if everybody know ERC, employee retention credit, very big. There's a big. I just came back from Florida about a month ago, and the IRS actually put a pause on that credit. So essentially, what happened with COVID 2019, 2020. They gave PPP, payroll protection, they gave money away, and then they also gave grants, and they also gave idle loans, right? So one last credit there was with the government was the credit retention program, which gave employers the ability to get up to $26,000 per employee. So there's a huge marketing effort that now companies tell you, hey, I'll do your employee credit retention credit, but they were charging people 30, 40% of whatever people were getting it, and they were paying it because, if I'm getting, I've heard stories people have gotten, $500,000, $250,000. So in their mind is, I'll pay the 20, 30%. I wasn't counting on that money. The challenge is in those type of tactics, they were qualifying or submitting applications for individuals that really didn't qualify. And it's gotten so crazy that last month the IRS had to put a hold on it. And in fact, they potentially have their own departments and or within the IRS to actually investigate individuals who've submitted for credits that they weren't really, they weren't merited for. One last question? And I'm sorry, did I answer your question, ma'am?
I actually have 2, but you almost answered it with the ERC. Is that for new applications or existing that it was paused?
So right now, new applications they're still being processing. The IRS has put on hold on new applications, and in fact, giving people the opportunity to retract their application if for some reason they don't feel they submitted it correctly, but because again, what was happening, you have these new companies wanting to get 30, 20% of that revenue and being too aggressive and qualifying people when they really didn't have the requirements to qualify for the retention and credit.
Thank you.
And
the last one I think is pretty yes or no. Solar is only residential, not commercial or business, right? The solar credit?
So solar, so dependence, if you, again, and this has to do with business, if you're doing an improvement to your own company, then you can deduct that more than, depreciation and all that good stuff. The one I'm speaking to is a 30% on residential. But I have clients that do both, right? Because if I spend $80,000 on solar panels in my building, I'm still able to use that credit. I think those are the questions. Again, yeah. Any other questions? Okay, Janetta, the last one.
You mentioned depreciation. Can you explain briefly what we need to look for with as far as commercial assets and how that all plays into the overall tax return?
Yeah, so depreciation is basically, within the IRS code, they give you the ability that when you have a large purchase, you have the ability to depreciate it. What does that mean? Is the terminology, how long, for example, if I have a commercial building and it costs me $1 million, unfortunately, the IRS won't give you the ability to expense that $1 million in that same year, right? So then if I have a commercial building, then I have to spread the expense in 39 years and a half. If I have a residential house, the depreciation years is 27 and a half. If I put a fence in my house, it's 15 years. So it depends. What type of item you buy determines how long you spread out the expense. And it's usually, as a tax benefit, have individuals right now, they have so much real estate asset that it's hard to get them to pay taxes because they use depreciation as a tax advantage to lessen or have no tax liability. All right, so I think this is my part for today, and I'll give it to the next individual.